Hey everyone, the third quarter GDP numbers have come out, and as expected, it was a big one. A record quarterly growth rate of 33.1%. The US economy is enormous, with an output of about $21.2 trillion. To put that in context, the US economy is a little larger than China's economy, Germany's economy, and Canada's economy all put together. But before I talk about what this means for commercial real estate, I'd like to clarify some of the things about what the quarterly GDP numbers really mean. First, the growth rate that is reported is a quarterly annualized rate. So when the government reports that we had 33.1% GDP growth in the third quarter, that does not mean the US economy grew by about 1/3 in that quarter. The 33.1% number is an annualized quarterly rate. So the actual number for the third quarter was a little less than 1/4 of that. The US economy grew by about $1.3 trillion in the third quarter, or about 7.4%. That's still a big number. It's about the same as the size of the entire Australian economy. We have never had a quarter with that much growth. But we have to remember that this is a rebound, a recovery from shutting down the economy at the end of the first quarter. And the economic losses that we had from that were also record levels. In the first quarter, the US economy shrunk by $243 billion, a 5% decline. And in the second quarter, the economy lost about $1.7 trillion, a quarterly annualized decline of 31.4%. So even though we had a great recovery in the third quarter as the US reopened, the US economy is still about $670 billion smaller than it was before the pandemic hit. It's about 3.5% smaller. So going forward, if the economy grows at a rate between 3 and 4%, which is about what economists are predicting, then we will get back to where we started in the second half of 2021. However, the speed and strength of that recovery will depend on what happens with the next round of stimulus and what happens with the health crisis. If there's no stimulus, growth could stall and the economy could flounder. If there's a big stimulus, over $2 trillion, then it could accelerate growth above the 3 to 4% range. The health crisis is the other variable. If the current surge in cases translates into another shutdown, that would likely cause GDP to fall again. On the other hand, if we get a medical solution and the pandemic is resolved, that would probably boost the economy. Setting aside all those variables and focusing back on the 3Q numbers, here is how this ties to real estate. Some components of GDP have done well, like the consumption of goods. This subcomponent wasn't hurt that badly by the shutdown, and it grew significantly in the third quarter. We have seen that playing out in the retail sales numbers, which are back above pre-pandemic levels. Both e-commerce and necessity-based retailers have increased their sales since the onset of the pandemic. This has led to increased inventories and, together with additional online fulfillment needs driven by e-commerce, we're seeing increased space demand for industrial real estate. On the other side, service-related consumption, another part of GDP, still has a long ways to recover. We see that playing out in the hospitality sector, experiential retail, and in areas dependent on destination tourism like Orlando and Las Vegas. Ultimately, the economy will recover. It's simply a matter of time. How long it takes will depend on medical solutions and whatever form of stimulus makes it through Congress and the president. But even without a full recovery, there are still parts of the economy that are going well, and real estate tied to those sectors have the strongest short-term outlook. The areas hit harder by the recession, on the other hand, could offer opportunistic investments. They will take longer to play out, but real estate investors need to think long-term and keep their eyes on the horizon.